Next are Matt MacFarland and Amanda Han. I had to mess it up because we were messing with each other back there. Matt has over 20 years of experience in public accounting. Amanda asked me to be brief on this, and I don't know how to do that. So, accounting as a CPA and tax strategist, he worked for both Big Four and regional CPA firms. Amanda has over 20 years of experience. How interesting. They must have met about then. As CPA with special emphasis in real estate. I have to mess with them because they usually tell a joke and I'm a part of it. So, self-directed investing and individual tax planning. They have best-selling books they've written, Tax Strategies for Savvy Real Estate Investors, and the sequel, the book on tax advanced strategies, Cracking the Code for Savvy Real Estate Investors. So welcome back.
Thank you so much, Bruce, for having us. And for those of you who don't know, Matt and I are married. And we did meet at work, so about 20 years ago.
There it is.
So thank you guys so much for being here. It's so lovely to see all of you. It's like they said, it's been a couple years since we had a live in-person event, and we missed seeing a lot of you guys the past couple years.
Yeah, so thank you for having us, to the Norris Group and everyone else for attending. We are going to talk about some year-end tax planning strategies coming up. Obviously, we're here in November, right? So thought we'd take some time to go over that, if that's okay with you guys. I think Bruce kind of covered this, so we won't go into that. But yes, we are married. We talk about taxes all the time. All the time.
Besides being CPAs, we are real estate investors ourselves. So we love coming to these events, hear what Bruce has to say about the market and just kind of meeting you guys, seeing what kind of deals you guys are doing. We do help real estate investors nationwide. So our firm's focus is on working with real estate investors specifically. We have people doing small single family, larger multifamily, to people who have day jobs and are just starting out and getting their real estate off the ground.
Yeah, when Bruce says that when he calls with questions and stuff, he's not kidding, right? So when Bruce calls, you drop whatever you're doing. Yes. It's like the bat phone going off, right? Like you got to answer him right away.
I run to Matt's office, like, oh my God, Bruce is calling.
Oh my God, it's Bruce. It's the world famous Bruce Norris.
And he never has easy questions, of course, which you'll see on the panel.
Well, the questions are always for his friend, right? My friend might be moving to Florida. My friend might be selling these lots. So we wanted to touch, obviously why is tax important? I think we all know it, right? But it's worth kind of reminding you guys why, we call it the silent killers of your wealth, right? So the highest federal income tax rate right now is 37%. There was obviously talk over the last couple of years of changing that. That's been tabled, and we hope it remains tabled, but you never know, obviously. Obviously, for those of us who are fortunate enough to live in this great state of California, we can pay upwards of 13% on our income. Lucky us. Payroll taxes, you guys got to, if you're working for yourself, you're working for somebody else, you're paying to some extent, 7.5% to 15% in payroll taxes, right? So that's also on top of your income taxes.
Yeah, capital gains tax anywhere from 15 to now 24% for higher income earners. And of course, when we pass away, we'll have to pay estate taxes. If you're fortunate enough to have larger net worth, which I'm sure Harry's going to talk about later on. But yeah, once you add all that up, we put together a pie chart just so you can see for someone who makes about $500,000 of income. That looks really sweet. After those various...
That's what $500,000 of income looks like right there.
After those taxes that we talked about, not even all of them, but you can see how much cash we have left. This is before estate taxes, right? So once we pass away, if we have to pay estate tax, a bigger chunk of that is going to go away as well. And that's why we're here, because how do we save taxes is with tax planning. And year end is the best time to be doing tax planning. I'm just curious, how many of you guys do year-end tax planning right now or every year? Oh, good. Okay, a couple of you. So let's talk about what is year-end tax planning.
Yeah, I mean, anybody sports fans in the audience, hopefully, right? So as you kind of know, like watching a sports game, some of you who are not sports fans may think that you don't have to watch the whole game, but you actually do. You need to, it's the whole game is important. But anyway, skip that point. But when it comes down to the end of the game, right, what's important is what the score is when the clock hits zero, right? kind of works that way with tax planning. So as we're coming up on December 31st, kind of what your numbers are on December 31st is going to determine, for a large part, what your taxes are going to look like for the year. After year end, there's still some things you can do to, tweak things for last year. But for the most part, you got to be proactive in making decisions and moving things around, making strategic decisions before December 31st, if that makes sense. So kind of talking about some strategies here. We're going to kind of go into a couple of buckets of ideas, if you will. The first one we call shifting strategies. So what does this look like? It could be a variety of different things. It could be shifting income to your kids or other family members that might be in a lower tax bracket than you. So hire them in your business, and instead of paying 40%, maybe you're saving at 40%, and maybe they're paying 0% in taxes.
Yeah, and that's it's just a matter of if you have kids who are older enough to help you out in your real estate business, then whatever you pay them could be a legitimate tax deduction to offset your taxable income, right? And I see some young investors joining us in the back there. I don't know if you guys are real estate investors, but maybe your parents dragged you here. Hopefully they'll pay you for your time in being here and learning about taxes, right? And I know, like Bruce, for example, right? He had his kids help out in the business. So think along the lines of what are those, for those of you with older kids, what are some of the things that they can do or can be doing? That's where the income shifting strategy comes into play. The key with year end is you do have to pay them before the year is over. We hear that a lot where people say, I heard you talk about it last year. I would like to use that deduction. Well, it's too late, right? The payment, the work has to be done before the end of the year.
Another shifting strategy could be just shifting income from one year to the next. So if you've got some control over, coming up on year end, and you have some way of controlling when maybe you delay invoicing a customer until January so they have no reason to pay you by December 31st. Or if you're looking at selling a property, right, it's going to close December 29th. There's something you can do to defer this transaction until January 2nd. If you're going to be in the same tax bracket, you're not saving any taxes, but the benefit of that is that you're actually deferring the tax an entire year, right? So that's a way to kind of shift income between years.
Yeah, and what's really important about that, like Matt said, not only are you deferring the taxes for a whole year, but that also gives you all of next year to plan for ways to offset that income. So we're seeing a lot of clients who are on the verge of, maybe they're going to sell real estate or their business and they're looking at a huge gain. Well, if you sell at the end of December, there's not a whole lot of time for you to reinvest that into other assets to offset this income. But if you delayed it into even January 1st, you have all of 2023 to look at what should I invest in? How can I offset the taxable income?
Could be shifting income to other entities, right? Maybe you're operating your business as a sole proprietorship or a single member LLC. Maybe it might make sense to convert that to an S corp so that you can minimize self-employment taxes. Maybe it's shifting into income to a C corp if you have like a property management C corp where you can kind of play with those changing the tax rates and things like that.
Mm-hmm. Yeah. So along the same lines of shifting, we were talking about deferring income, but also accelerating expenses as well. So taking a look, for real estate investors, taking a look at what some of your recurring expenses are for next year. So I know in January, I always pay property taxes or insurance, or I have this marketing or software.
I always pay my CPA in January. Maybe you want to pay in December.
Right. We have a lot of clients here. So if you prepay those before the end of the year, then you can take a tax deduction, right? If you prepay those by the end of this year, it's a deduction. You accelerate the write-off by an entire year.
I guess that doesn't help us defer income, but.
Yeah.
Okay, so we also wanted to show this to you guys. So recently with the Inflation Reduction Act, the IRS has they've earmarked about $80 billion that's going to go to the IRS. And it's interesting to kind of see the layout of how that money is going to be spent according to the proposal. So we've got about $45 billion going to enforcement, $25 billion to go to operations, another almost $5 billion going to system modernization, and $3.2 going to taxpayer services.
What was really interesting was Karen was just talking earlier, right? That you with the IRS people in Washington, D.C., and they said most of this money is going to go to friendly people picking up the phones. Well, that's not what the budget actually says, is it? Most of that is going towards IRS audits.
Yeah, how many of you guys have actually tried to get a hold of the IRS in the last 2 years, right?
Oh.
Yeah, okay, so you guys are all alcoholics now, right?
Yeah, the issue is they don't pick up the phone, right? They don't open mail. And so when you finally get a hold of somebody on the phone, what do they say? They say, write to me. We said, well, you didn't open the last mail that I sent 6 months ago. How is the second mail going to do
Not only
any better?
they don't open mail, then they send you the follow-up letter to the first letter without reading your response yet. So yeah, so obviously we would like to see this flip-flopped, right? We'd like to see more money going to taxpayer services, system modernization. But funny thing, we looked up operations support once. What does that mean? We were like, what does that mean, right?
Yeah, that's a lot of money going
One
to.
of the things in there was, what was it? Was
paying rent.
paying rent.
So IRS is budgeting a lot more money towards rent. I think it's because they're growing headcount. So I think they need office space to house those
That means
auditors.
they need landlords to buy those properties to rent it to the IRS.
Yes. So for
investors.
real estate investors, what better tenant to have than the IRS?
They will pay all the time.
I mean, yeah, that's great. We'll install some cameras and see what they're talking about, what they're looking at. So, obviously, these numbers concern a lot of our clients, a lot of investors. Does it mean we should stop doing planning? What does that mean for the deductions I'm taking, right? And so it's important to understand that the whole purpose of doing tax planning is so that you have the right facts in place so that if you're audited, you can substantiate the position you're taking, right? So if we're talking about income shifting to our kids, we're not just talking about it, we're actually doing it. We're hiring them. We have the documents. They're doing the work. We're paying them. So if you're doing the right things during the year, then we're not super concerned because if we're audited, we have all the right things to prove our position, right? So I wouldn't be really concerned with these numbers. The action item is just to make sure you take more care in documenting what your positions are.
Because remember, if you do, God forbid, if you do get audited, it's not going to happen 2 months after you file your tax return, right? It's going to happen 2-3 years down the road. And so, could you get documents together 3 years down the road? Yeah, I guess you could, right? But it's a heck of a lot easier to do that now. Get everything in a row, ducks in a row, so that if it does happen, you're ready to go, and it's a slam dunk, right?
Yeah. If you're like most people, if you're like me, I hardly remember what I had for breakfast 2 days ago. So can you, if someone asked me 2 years from now what I did on such and such date, I would have no idea.
So talking a little bit about real estate investors, some of the things that come to mind with year end is, I know we got a lot of people who do real estate full-time in the room, right? So hopefully a lot of you who are doing full-time real estate, you've got rental properties, you're claiming real estate professional status. So one of the things coming up on year end is, make sure, again, for enforcement reasons, right? Make sure you've got your hours documented. You're keeping track of those. If you're coming up on year end and you need to get to 750 hours, how many more hours do you need between now and year end to meet the qualifications, right? Because obviously it's going to be, almost impossible to make up hours after year end, right? Like if you didn't get to there, right? So that's the thing to think about as you're coming up on year end.
Yeah, and just real quick, what's the importance of being a real estate professional? So in the tax world, our goal is to have cash flowing rentals, but having enough expenses, write-offs, and depreciation to create a tax loss. So if you're someone with higher income, though, if your income is over $150,000, for long-term rentals, you cannot use that loss to offset those other income, like W-2 or your business. And so the way around that is if you or a spouse is a real estate professional. And that's why it's really, really important that if you are going to be claiming real estate professional to use those losses, make sure you have enough hours. And if you don't so far, you have the rest of this year to do more in real estate so you can create those hours and be able to use the losses.
Now, real estate professional is applicable for those of you who have long-term rental properties, right? So the tenants are staying there, over 30 days a year, the typical type of stuff. But I don't know anybody in the room doing short-term rentals? Okay, so there's a couple of you. So in terms of the strategy there is with short-term rentals, for tax purposes, just so you guys know, it's the average customer stay is 7 days or less. And in terms of what Amanda just talked about, in terms of if you create a loss on your short-term rental, how do I use it to offset my other income like a real estate professional would do with their rental losses? You can do that with short-term rentals if you meet one of the material participation standards. There's a couple different ones that, we don't have time to go into all of them, but you guys can ask us about it later. But a big one is, did you spend 500 hours on your short-term rentals during the year? So again, coming up on year end, figure out where do you stand. Because that's a huge strategy for those of you who aren't going to qualify as a real estate professional, but you're still actively involved with your short-term rentals. You can use those losses to offset your other income. So obviously, one of our favorite strategies in our tool belt, right, for real estate investors is depreciation. So a couple of things to think about here is with year end coming up. This is going to be the last year of 100% bonus depreciation, and again, unless the law changes, but it's supposed to be 100% bonus depreciation this year. It drops to 80% next year, 60% the following year. So it's not going away. 80% next year is still better than nothing. And also, there's a misconception out there that, if I don't get 100% depreciation, I lose it, right? But you still, like next year, if you get 80%, you're still taking the other 20% of your assets, you're still writing off over 5 years. So you're still getting it. It's not like you're losing it. But again, the difference is if you can put an asset in service this year, so maybe you buy a rental property, you can do a cost segregation study. You're breaking out the 5-year assets, the 15-year assets. Those 5 and 15-year assets are eligible for bonus depreciation, meaning you can write off 100% of it this year. So typical example, we'll have a client that buys a $300,000 property. Not uncommon right now to see with 5 and 15-year assets, you're seeing about $100,000 allocated to those. It's $100,000 depreciation write-off this year. So again, those of you, short-term rentals, this happens a lot with our clients doing short-term rentals. Coming up on year end, maybe you can close on a property soon, put it in service by December. It rents for 2 weeks to 7 different people. It's a short-term rental. You put it in service, you can do a cost seg, take a lot of depreciation against your income this year.
Yeah, it's really key. I mean, obviously the deal has to make sense, but if you can purchase and put a property into service this year, it could be pretty impactful because this is the last year of the 100% bonus depreciation.
I mean, that works for long-term rentals too, obviously. You can put a long-term rental, you can do a cost seg on that. As long as it's in service by December 31st, it's a rental property for tax purposes. Okay, talk about some offset strategies. So what do we mean by offset strategies? It's kind of like those one-off things where you've got, a higher income year. We're looking for one-off things to do that we can reduce our taxable income. Obviously, we talked about real estate, but some other ones that come to mind, charitable gifting strategies. There's a whole slew of things you can look at. I know Harry's got a lot of experience with that as well. There's things you can do with donor-advised funds, charitable lead trusts, things of that nature that you can utilize real estate and still take tax deductions for your donations, and it can work really well.
Yeah, usually when we talk about real estate, in terms of selling real estate, most people are looking at 1031 exchanges, which Frank is going to be talking about real soon today. But this year, we've had a lot of clients whose 1031 didn't really work out well because of the market, because they weren't able to find the right deals or within the right time frame or within the right price to close on. And so what happens is they have taxable gain, right? Either full gain or partially failed 1031 exchange. And that's where we look at offset strategies as well. So just because you have a failed 1031 exchange, there are other things you can do before the end of this year to potentially defer that capital gain. So one thing might be investing in opportunity zone funds. If you haven't heard about that, you can look it up or you can ask us questions later on. But that's a way for you to defer capital gains taxes, not just from the sale of real estate, stocks, sale of businesses. It's a really great way for you to get some tax deferral and also some tax-free growth as well. We also have clients, again, if you failed a 1031 exchange, but if you bought on your own another rental property before the end of the year and you put it into service, that could be an offset to the gain on the property that you sold. Or even if you're just going to invest some, passively in someone else's syndication fund, like a mobile home park or self-storage, those losses can potentially help offset the gain on your sold property too. So again, year end is the key. If you had large gains this year, whether it's from real estate or stocks or crypto, make sure you're looking at ways to offset that gain before the end of the year.
So real quick, we just want to mention, for those of you, kind of don't see it right, something that's really important to note is that tax return filing is different than tax planning, okay? So a lot of people may think that, hey, I go to a CPA, meet with them in April or whatever, they're doing my taxes, they're going to do tax planning for me. That's not the same thing as doing proactive tax planning throughout the year. Being strategic about making decisions about what you're going to do before you sell the property, right? Have that conversation like, hey, I'm thinking about buying a new piece of equipment for my business. Shoot an email to your tax advisor. Just doesn't have to be a lengthy conversation, but just something to make them aware of what's going on in your situation, right?
Yeah. And so for those of you who want more information, like I said, time is of the essence. Make sure you're talking to your tax advisor now, because they might be traveling in December for those of you who are our clients. So call, if our clients call soon, if you're someone else's clients, call them soon, because it takes time to analyze and implement some of these things. What you do today determines how much taxes or how little taxes you pay next April, right? So if you want more information, you can, this is a QR code for, we have a free tax savings toolkit. You can check it out on our website.
She had to explain to me what a QR code was, just by the way, but I'm okay admitting that. That's all right.
Thank you.
All right, thank you. We want to get out of here before Joey turns our mic off.